If you're still memorizing stupid candlestick patterns in 2026, you're cooked. Because the market isn't moving because of engulfing or pin bar candlesticks. Those are just candlestick patterns. The real signal is what they are hiding, who got trapped, where liquidity just got taken, and whether price has real intent or is it just bait. So in this video, I will show you the 5 things nobody understands about candles and how to use candlesticks the correct way as a confirmation, not prediction. Anyways, if you're new here, my name is Brett Goh. I've been trading for 7 years, made over $2 million in profits last year alone. Every single trade documented live on my second channel, Brett Trades. In addition to that, I've helped hundreds of traders become funded with 6 figures. And right now, I'm building Edgeflow, the trading super app for discipline and consistency. So quite simply put, I don't want your money. I want you to stop making the same mistakes so you can make money. Let's get straight into it. Yo, quick pause from the video. If you've been watching me for a while but you are still not consistently profitable or making the money that you want from trading, listen up. From March 24th to 26th, I'm running a 3-day live trading bootcamp where I'm teaching the exact habits and mindset shift that took me from losing tens of thousands of dollars to now making millions a year. It's the exact same mechanical trading system that helped over hundreds of my students go from inconsistent and unprofitable to now getting funded and consistently making anywhere from 10k to 50k a month. Because here's the truth, you probably already have good enough strategies to be profitable, but the real reason that most traders still lose money is because they don't understand how the market works and they never fix the habits and psychology that's keeping them broke. And that's exactly what I'm solving with this 3-day bootcamp. Anyways, tickets are now live and on early bird pricing, so grab yours before the price goes up. It's the top link in the description. Now let's get back to the video. Most traders are out here treating candlesticks like they are magic signs. Green candle, buy. Red candle, sell. And that's why you keep buying right at the freaking drop and selling right before it starts pumping. Now here's the truth about candlesticks. These candles on the screen, they don't create the move. Candles are essentially just the scoreboard after the move already happened. Which means a bullish candle doesn't mean price is going up. It only means that during that time window, right, when the candlestick is forming, buyers have managed to close higher. Buyer won the tug of war against the sellers. That's it. That's what a bullish candlestick actually means. It doesn't necessarily mean that price is going to go up right now. Similarly, once you see a red candlestick doesn't mean that price is going to go down right now. If it was this simple, every Tom, Dick and Harry would be freaking millionaires, innit? And this is exactly why the concept of buy when you see a green candle and sell when you see a red candle doesn't work. Because by the time the candlestick turns green, the move is often already done. And right now, you're just simply like the last person chasing the move. Which means that if you're trading these candlestick patterns, you're not early. You're simply going to be the exit liquidity. And I view trading as simply a game of liquidity awareness. The more consistently you can spot where liquidity is resting and when it's about to get taken, the higher your odds of winning, which means higher chance of you making money, which means more profits to you. And the thing is, the traders who do not understand liquidity, they don't lose money to the market, they become the liquidity. So when you analyze a candlestick, instead of asking yourself, what pattern is this? Is this the engulfing candlestick or the morning evening star or whatever voodoo candlestick pattern? You should be asking yourself, where is this candle printing? And who is it trapping? Those are the essential questions for you to understand the context, for you to understand the objective of price. Now, unlike all of these trading gurus who like to use fancy words to explain shit that they don't really understand, I'm gonna make this stupid simple. So simple that even a 5-year-old can understand. Because I really believe that if you can't explain something simply, you don't understand it well enough. With that said, let's get into the 5 truths about candlesticks. You know what, let me take that back. I want to sound more cool and clickbaity while saying it. So I'm gonna expose the 5 dark truths about candlestick patterns that the banks are hiding for you. Let's go. The first truth is candlesticks are essentially an auction story. Right now, imagine a tug of war between your buyers and sellers. Each candle is simply the scoreboard for that time period. For example, right now I'm at the 1 minute time frame, and this 1 minute candlestick is forming as we speak. And right now there's this tug of war going on right here between the buyers and sellers, right? So they are like trying to see who can take control of price, because whoever end up taking control of price determines the direction in which price is potentially going to go. So when you look at the anatomy of a candlestick, you will know that there's your opening price, and then there's your closing price, and then there's the high, and then there's the low. The opening price is essentially where the game started, right? Where the tug of war began. The high is how far buyers managed to push price all the way up. And the low is how far sellers managed to push price all the way down. And the close is potentially who won at the end of that round. So when I look at a candlestick just like this, what this is telling me is that at some point of time, price opened right here, and then during this candlestick while it's forming, during this 60 seconds, during this 1 minute while it's forming, there was actually surprisingly a good amount of sellers who caused price to actually come all the way down here, right? Push price all the way down here. But then there's also a group of buyers who managed to push price all the way up here, right? But that was not sustainable, right? So as a result, sellers came into the market and caused price to collapse, right? Selling pressure, push price all the way down here, and the candlestick ended up closing right here. Basically, the top wick told us that the buyers tried to go up, but then they got slapped back down. And then the bottom wick told us that the sellers tried to go down, but then they got slapped back up. And when you see like a very long wick just like this, either upper or lower wick, it often means rejection. Okay, like this is something that we're going to talk about more in the next truth, right? But for now, just understand the anatomy of a candlestick and the tug of war to see like who's gonna get control of price, whether buyers or sellers, whether demand or supply. And the thing is, in trading, size does matter. Okay, size matters. And what I'm talking about is the size of the candlestick body. When you see like a big ass body just like this, what I call the BBC, the big bullish candle, this basically means that there's a lot of momentum, right? There's a real push in price, and there's very less hesitation. There's a lot of buying pressure. But then when you see like a small candle body just like this tells us that more often than not, there's indecision in the market, right? There is nobody knows whether price is gonna go up or price is gonna go down, right? So as a result, price just like consolidate around here. Okay, so this is a sign that there's indecision in the market. Is indecisive. We can't tell whether the bulls or the bears are winning because like they are still like just breaking even on this like tug of war. But then over here, it's clear as day that the bulls are winning because we got this big ass juicy bullish candlestick body. So just to sum it up, the candlestick that is forming right now, that's the fight. The close of the candlestick is who won the fight. And all of these wicks right here are failed attempts. So the next truth is candlesticks only matter at locations. What I basically mean by that is that you don't want to obsess over candlesticks when they're in the middle of nowhere, like freaking Wyoming, okay? Like you only want to care about candlesticks that is at a desired point of interest, at a location in which we want to be trading from. And I fundamentally view candlesticks as words. You know, in English, words mean nothing unless it's in a sentence. Let's say the word handsome, right? So handsome itself means nothing. But if you put it in a sentence like Brad is a handsome trader, then that means something. It means that I am indeed a handsome trader, right? So a word alone is meaningless unless it's in a sentence. And if you apply that to trading, location is the sentence. So the candlestick alone is the word, it means nothing. But if you put it in the location, at the right location, it forms a sentence and it means something. It allows you to have context over what price is doing. So you can develop your bias on whether price is reversing, price is blustering right to the point of interest, whether you should enter for a buy, whether you should enter for a sell. So to me, there are a few locations that make candles matter. Number one is previous swing low or swing highs, right? So basically, when price breaks structural, just like this is the swing low, this is the swing high, since this is the highest point before price starts pulling back. So this is where I'm going to be observing the candlesticks. Same as when price approached the swing low right here. And also, when you draw these swing highs and swing lows, you can also draw your supply and demand zone, which is another location that actually make candlesticks matter, right? So there's a supply zone right here, there's a demand zone right here. And then another place could be liquidity pools, right? So for example, there is available liquidity sitting below this swing low right here because the retail traders who entered for a long positions right here, they're going to be placing their stop loss below this swing low here. So as a result, there is going to be some form of liquidity sweep, like exactly what we have right here. And what happened was that price pretty much came crashing down, right? You can see there's a lot of selling momentum, a lot of selling pressure. But as it approached this demand zone, approached this swing low, approached this liquidity pool, it came down, swept the liquidity, and it started reversing very heavily right here. So if you didn't understand the context of price, you didn't understand the location, you couldn't spot where the candlesticks are, you're going to be thinking that this is price going down. So as a result, you're going to enter for a sell right here because you are convincing yourself that there's a lot of selling pressure, selling momentum in the market. But then what happens is that price just start reversing against you, all because of liquidity, all because of the higher time frame objective. That's it. So basically, just to sum it up, the swing highs and the swing lows are essentially where price already proved that people care, right? That is why we got this bullish break of structure being formed. It tells us that the buyers are actually in control of price. And then the zones, right, the supply and demand zones, these are essentially the battleground where buyers and sellers are trying to take control of price to see who actually wins, because whoever wins dictate the direction of price. And then there's your liquidity, which is essentially where the market hunts stop losses, hunts stop orders. And then after the liquidity has been swept, we got this huge displacement right here as well, right? Like this huge displacement candlestick, which tell us that the market is essentially shifting bullish, right? So this is where the market shows its hand. So to me, I have like a very simple rule inside my mechanical trading system, which basically states that if the candlestick is in the middle of nowhere, that's just noise. I don't even bother analyzing it. I don't even bother looking at it. For example, if this is my swing low or my demand zone, whatever, and this is a swing high, I'm only going to be paying attention to the candlesticks that is formed when price reaches this location here, or this location here, which means if price is in the middle of like right here, right, I don't care. I genuinely can't be bothered to actually analyze the charts because that's just noise to me. So just to give you another analogy, a scary candlestick in the middle of the chart is like shouting in an empty room. Nobody cares. But the same candlestick at a major point of interest at a major level is like shouting in a courtroom. Everybody's going to be looking at you. So it's the exact same candlestick, but if you put it in different locations and you give it different context, it will give you different results, right? So for example, if you see this right here, it's at a perfect location. You know, you got like this reversal candlestick pattern, which tells us that price is going to go up. This is where you can enter for longs, right? And it's most likely going to work out because it's at the perfect location. But then if you see the exact same pattern, like let's say somewhere around here, then what happens is that it's not going to work out as well because price is in the middle of nowhere, right? And it's really not at a desired point of interest. So that's how important it is to take into account the location and the context when you are using these candlestick patterns or candlesticks in general. The third truth is that candlesticks must be read in sequence, not snapshots. Now, once again, I'm just gonna explain it in like a fifth grader level. Basically, one candlestick is one word. A few candlesticks in a row is a story. One word alone means nothing without context, right? Which means that you need to rely on the subsequent candles or the candles that came before that one candle to understand the context of the market, to understand the story of the market itself. So basically, you want to look at the 3 to 5 candlesticks at any given time, rather than just relying on one candle alone. So for example, look at this blank chart. I'm going to take this 5 candlestick right here. And when I do that, I'm going to be asking myself the following questions. Are the closes getting higher or lower, right? Is the candlestick closing higher or is the candlestick closing lower? And over here, I can see that the candlestick was closing lower, right? It closed here and it closed here and it closed here. So this means that there was bearish momentum in the market. But the next candlestick is started closing higher. And the next thing is, are the wicks getting rejected repeatedly at the same price? What I basically mean by that is that if you look at a wick, right, and observe where the price is wicking towards to and where price is like, you know, getting rejected from. Okay, so for over here, right, price actually came down. When this candlestick was forming, got rejected, hit back up. Same thing right here, came down again, got rejected and hit back up. And then later on, price came down, got rejected and hit back up as well. Right, so this means that there is quite a good amount of like buy orders sitting in this point of interest itself, which means that the next time price actually come down here, there's gonna be buying pressure, right? Which explains why when price came down to this area here, price pretty much retested it with this super duper long low wick, but then it ended up closing right here because there's a lot of buying pressure, and then eventually the buyers overwhelm the demands, and then it starts causing price to reverse. And are bodies getting bigger, which signal momentum, or are they getting smaller, which means that the price is just stalling? So look at this, clear as day, you can see the candlestick body of the bearish candlestick start getting smaller and smaller, which means that the selling momentum is like fading away. And then boom, you got a huge big bullish candlestick right here coming into the chat and just like engulfing all of these like previous small candlestick right here, which means that there's a lot of bullish momentum in the market. And I can see at this point of time, there is like barely any selling pressure whatsoever, right? Like there is really barely any sellers in the market. The demand just came in here and just kicked the stupid sellers out of the market. And this is a clear sign that the market has actually changed behavior, right? Price shifted bearish in the short term to facilitate the pullback. And then right now, the market is in alignment with the higher time frame structure, the higher time frame trend, which is bullish, and that causes price to continue going up just like this. So those are the 4 questions that you want to constantly ask yourself when you're analyzing a group of candlesticks, right? Because like I said, you don't just want to read candlesticks like photos. You want to read them like a movie. And in order for you to read them like a movie, read them like a story, you have to get context, which means you can't just depend on one candlestick alone, right? You need to depend on the most recent 3 to 5 candlesticks, and you can figure out the context of the market when you ask yourself these questions right here. If you see 5 candlesticks just like this struggling to go down, and then you have this big juicy candlestick comes in, slams the market up and closes very strong just like this, this is essentially the market saying that we are done selling, we are done going down, it's time to skyrocket, baby, we are going to the moon, baby. That's it. The next truth is patterns are useless without the before. Now, the same candlestick can mean totally different things depending on what happened before the candlestick was formed. You know how when you ask your girlfriend, hey babe, are you okay? And then she answers, I'm okay. And that I'm okay can mean 1,000 different things. It can mean she is really okay. It can mean she is actually really upset. She can mean that she's really angry and a million other different things, right? So that is essentially what it means in these candlestick patterns, right? Like you need to understand what's the before, right? What happened before you ask her if she's okay. You need to understand the context of the market itself. And it's the exact same thing right here. For example, when price was like pushing up just like this, and you spot this bullish engulfing candlestick right here, tell us there's a lot of bullish momentum in the market itself. But then you must ask yourself, did price run a lot already? Is price overextended? Because if it is, even though this is a signal that you should enter for a buy, it could be too late, right? The bullish pattern could be too late. And the thing is already like sitting at this supply zone that we have right here, which tells us that there's going to be sellers going to be stepping into the market and pushing price down as well, right? So it's a bullish pattern, but then because of the fact that what happened before that was that there was already such a huge push, now it's overextended, which means it doesn't make sense for you to enter for a buy here. And then another thing you can ask yourself is, did price just hit an important level? For example, there's this demand zone that we can mark up right here, that swept liquidity below these swing lows here, that caused price to break structural and caused price to go up just like this. And right now, as price approached this demand zone, we have seen price started reversing at this point of interest, right? Which we expected that to happen because of demand in the market, because there's a lot of buyers in the market that were sitting at this demand zone just waiting, to enter for a bunch of buy orders when price came back down to this area here. And that's exactly why price got a real reaction from this point of interest, because price had hit this important level. That's the context, right? That's what happened before this candlestick pattern was formed. And then another thing is, was there some form of liquidity sweep right before the move? For example, over here, there was available liquidity being built up below these equal lows right here. So as a result, when price came down here, swap these equal lows, smart money pretty much use all this available liquidity to cause price to start going down. So when you see like this candlestick right here, it could pretty much mean that we already got a liquidity sweep. This is a reversal candlestick pattern, and more often than not, price is just gonna like start reversing and start going up. Right, and as a result, it did went up for a period of time until price reached what? The next supply zone, and then just continue in the bearish trend direction. Which brings me to the last question that you can ask yourself is it a trend continuation or a trend exhaustion? Because patterns tend to work a lot better when they're aligned with structure. For example, in this particular case itself, price pretty much after the liquidity sweep, it went up to this supply zone. And we know that in a downtrend, price is going to be creating your lower highs and lower lows. So we can pretty much expect price to create like another new lower high right here when price mitigate the previous supply zone, mitigate the previous swing high. And when this actually happens, we can also expect like the reversal candlestick patterns to actually work out well, because this move right here is aligned with the higher time frame swing structure. So here's what you can potentially ask yourself before the candlestick was formed, before you start identifying the candlestick pattern and all that shit, right? You want to ask yourself, where do we come from, right? What was the prevailing trend? Are we at a level that matters? Are we at some form of supply zone or demand zone whatsoever? Did liquidity just get taken, right? For example, in this particular case, I could see that there's some available liquidity sitting above these highs, so price could potentially be sweeping that and cause price to start going down. Did we get displacement, which is the real move yet? Well, not yet, right? Because if price wanted to start shifting bearish, you will see like a big bearish candlestick right here. A lot of selling pressure will step into the market and cause price to start making like a drastic pullback or even like a significant reversal. So those are the things that you want to ask yourself once again to get context on price instead of just blindly relying on memorizing candlestick patterns and analyzing candlestick by itself. Now you're able to get the full picture. Now you're able to really read the entire story on what price is actually doing. And when you have this context, it tells you whether that move is actually a real signal or is it just noise. Or is it just a trap? Now, speaking of context of price, let me just show you some quick examples. For example, when you have these multiple small candlesticks just like this, and they've suddenly got these big ass candles right here, this pretty much means that price was compressing, and then right now after the compressing, it's gonna start to expand heavily, right? So this is the nature of the market. It moved from balance to imbalance and eventually balance again, and then to the next imbalance right here. So the candlestick pretty much tell us which phase the market is in right now, whether it's in the compression phase or whether it's in the expansion phase where it has gained sufficient momentum and right now price is pushing to the upside. And then there's your push, stall, reverse, right? What happens is that there's a lot of selling pressure, very aggressive. Price started pushing price all the way down here, but then there was not enough selling orders for price to continue going down. So as a result, it continued stalling right here, just like sitting over here, not really doing anything, quite indecisive, and then it started reversing heavily right here, right? And this pretty much meant to us that the sellers right here, they got absorbed. And then the buyers pretty much took back control of the market, and this means that price is most likely going to do this next. Another significant pattern that you need to take note of is a sweep week. Right, so when you see there's like a very strong close in the opposite direction, just like this means that could potentially be a trap and the market is potentially shifting. What I basically mean by that is that when you can see this huge bullish candlestick right here, if you don't understand the context of price, you can't spot liquidity. What happens is that you're going to assume that the next candlestick is bullish as well. And as a result, when it's printing, you're going to enter for a buy. But what happened right here is, once again, if you read the anatomy of a candlestick, you will know that at some point of time, price got pushed all the way up here. So there is indeed buying pressure, but then there was insufficient buying pressure. As a result, sellers caused price to push all the way down here, and it ended up closing right here, leaving behind this super duper long upper wick, which signaled to us that there was a trap being formed right here, and this was a clear as day, a liquidity sweep for smart money to clear the remaining orders above these highs right here. And right now we are shifting bearish to the downside. That's it. So the fifth truth is candlestick size is relative, not absolute. What I basically mean by that is that a big candlestick is only considered as big when you compare it to the other candles that is around it. So similarly, in kindergarten or whatever, a tall kid is only considered tall in kindergarten, but when you go to high school and you compare the tall kid to the other people right there, he's no longer tall, right? Because the other people are around the same height. Same thing right here. That's what it means to be relative, right? When we talk about the absolute size of the candlestick, it refers to the exact price range which a candlestick covers, right? Like a $10 move or like 20 pips or like price changing or going up or down by 2%. So the absolute size tells us how much the price has moved, but it doesn't really tell us if that movement is significant. For example, let's look at Bitcoin. When you see right now there's like this $50 move in terms of Bitcoin prices, it might create like this tiny candlestick right here, right, which is considered as low volatility since price is like at like 80k, 90k right now. But that same $50 move would be considered as a huge candlestick, which signal there's a lot of volatility in the market if Bitcoin was priced at $500. That's what I mean when you measure candlesticks in terms of absolute rather than relative. And relative size basically refers to how a candlestick looks compared to the candles that is immediately preceding it, right? Before it or like after it, whatever. And this is what professional traders actually look at. This is what they use to understand the context of the market. So when someone says that the candlestick size is relative, what they basically mean is that you should judge the candle strength by its neighborhood, by the candlesticks that is within its immediate proximity. And usually you can categorize it into 3 different groups. There's your expansion phase, right, which is where a candlestick is 2 times or 3 times larger than the previous 5 to 10 candlesticks itself. And when this actually happens, clear as day, lot of momentum, lot of pressure in the market itself, there's very high conviction, which means that a new trend or breakout could be happening soon, or it has already happened. And then there's also your contraction phase, where the candlestick is a lot more smaller than the previous candles, right? So for example, if you compare these candlesticks with like these previous bearish candlesticks itself, what it pretty much tells us that the selling momentum, the selling pressure is fading away. As a result, the market right now is kind of resting, the sellers is kind of out of the market right now and is quite indecisive as a whole. And then there's also your average phase, where the candlestick is roughly the same size as those before it, right? So you can see right here, all these candlesticks are roughly the same size, not exactly the same size, but if you compare this one to like this random one right here, you can see it's roughly the same size, which tells us that there's like a stable trend, the market is indecisive, there is no change in market intensity or volatility right now, and sooner or later, price will do something like this, where it breaks out with like a bullish candlestick or like a bearish candlestick to dictate what price is going to do in the short term, in the price action that is following after like this consolidation right here. Here's some other examples, right? Big candle after many small candles, breakout energy, so we are actually expanding. Big candle into a level, right? For example, you see like there's this demand zone right here, but you can see like a big candle coming to the level right here, but it immediately starts pulling back. This means that it's most likely going to be rejecting that point of interest, that strong level right here. Or if you see like a big candlestick just like this, but then there is no follow through, right? So maybe the subsequent candle is just small candlestick right here, not much momentum. This is usually like what we call a bull trap or like a bad trap, where there's like a fake strength coming to the market, when in reality it's just like entice retail traders to take the wrong trade. Or if you see like a big candlestick just like this, which is inside a chop, this could just be a random spike in price action. It doesn't really mean anything because the market is actually in this consolidation phase right here. So I personally like to judge the volatility of the market or of an instrument on a day-to-day basis. And what I mean by that is that on some days, price is going to move like crazy, right? Like you can see crazy days right here, big bullish candlesticks right here. This means there's a lot of like momentum in price. But then there's also going to be days where the market moves very little, right? For example, you can see these small candlesticks right here. These are the days where the market barely moves significantly at all, right? So if today is a big movement day, right? It's, let's say like if you break down this candlestick, this big bullish candlestick right here, you will know that big candlesticks are normal on the lower time frames. But then if it's a slow day, right? If the market is like sleepy, like right here or something, and then it suddenly prints like a monster candlestick just like this, when it's sleepy, this means that the freaking monster has woke up, right? And that is where you should start paying attention that the next expansion phase is about to happen and the market is about to like go up tremendously. And I'll just give you like this simple trick that you can follow, okay? Basically, after a big candlestick just like this, observe the next two candlesticks, because the next two candlesticks will tell you everything. If they hold and continue, this means that this is indeed a real move and price is potentially just gonna do this. But then if they start stalling and reversing, right, this means that potentially this could be a trap, and right now price is potentially heading back down even lower, right? So observe the two subsequent candles after the big candle itself to understand whether this move is actually real or fakey. Alright, so those are the 5 truths that every single trader who's trading candlesticks need to understand. If you're trading price action, if you're even touching candlesticks or touching trading at all, you need to understand these 5 truths. And I'm just going to quickly end it off by giving you a 3-step framework that is simple, that works, and is repeatable. So the first step is to identify the location of the market. Remember, we don't look at candlesticks when price is in the middle of nowhere, right here in freaking Wyoming. No, we wait for price to get to our location, right? So for example, there's this demand zone that I've marked up right here. Okay, so when price is up here, do nothing. Price come down to this demand zone, do nothing as well. Boom, when price mitigate the demand zone, boom, this is where I'm starting to pay attention to the candlesticks that is forming around that location, around that point of interest. So when price approaches this point of interest, next step, wait for displacement or rejection, which is often a big body close through and away from the level itself. So if I'm looking at this just like this, what we had was that price was pretty much very aggressive coming into this area here, right? You can see very big bearish candlesticks right here. But if you observe the candlesticks, you will realize that there's also a lot of like low wicks being formed right here. You can see all of these are very long low wicks right here, which could signal to us that, you know what, there's actually a lot of buyers in the market just constantly pushing price up, just constantly slapping the market up here and there, right? So as a result, it's only a matter of time till price starts reversing. And where is price most likely going to reverse? Well, it's most likely going to reverse at this demand zone that we have marked up right here. And that is exactly why we wait for price to come down into here, and then we observe the candlestick that is formed at this area here. And is there like some form of displacement? Is there some form of rejection? Yes, there is, because when price came down here, it mitigated the zone. It creates like this long low wick right here, and then it ended up closing higher like around here. And then the next candle ended up closing higher, and then boom, bullish engulfing candlestick right here, which caused price to just start reversing and head back up. Which brings us to the final step, right? Which is that you want to use candlesticks as an execution trigger, as an entry confirmation, right? It shouldn't be your only confluence, right? If you have watched my videos, you have went through my courses, you will know that I look for a lot more confluences than just this. Okay, it's not just as simple as looking for candlesticks and just doing this 3-step process. There's a lot of different variables that you need to take into account as well. This is just like one of the final pieces of the puzzle that you need to find before you can develop your masterpiece, right? Which means that it's one of the final entry confirmation that you need to get before you actually get in for the position itself. So there is your strong close back into the zone. There's your failure to continue, like failure for price to continue even going down lower, right? You can see clear as day, there's a very long low wick being formed right here. There's a very weak close, which means price is going to reverse right now. Or like sometimes you could even have like a break retest, right? For example, when price break out, came back and retest this area here, right? And then as a result, the candlestick closed higher, and right now we are actually pushing up even higher. Okay, so those are the 3 steps that very simple, very methodical, repeatable, and scalable. You can just take them. But like I said, this is really like just the tip of the iceberg when it comes to everything that I personally teach on this channel itself. All right, cool. That's it. Basically, you need to understand that candlesticks aren't magic, right? They are simply evidence. So you want to make sure that you're using them at the right place, in the right sequence, at the right time, and then you will stop being late. Okay, so if you want to learn more about how to combine candlesticks with like a proper mechanical trading system, check out this video right here. I'll walk you through my entire trading strategy from top to bottom. No weird jargon or fancy complicated bullshit, no fluff. It's just my entire trading strategy summed up at a 5th grade level, right? So if you're a 5th grader, go and check that out, man. Even if you're an old man and your teeth is about to fall apart, check that out as well, right? Because you want to be rich before you die. Yes, sir. All right, remember, you're just one trade away. Mwah.